Hello, good morning to all. Welcome to today's daily dose of market insights and happy Friday. And in fact, happy Black Friday due to the Friday after Thanksgiving. So good morning to all. This is Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Today will be Friday, 24th of November. So before we start our daily dose of market insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This documentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. And as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as we know that yesterday is a rather quiet day. Why? Because of the US Thanksgiving session, where the cash US equity market is closed. And yeah, we do have the fixed income market open. The FX market is being open, but given the fact that it's a Thanksgiving holiday in US, so liquidity tends to be much lower. So that actually explains the much, we call it lackluster activity, especially in the benchmark stock indices, given the fact that some of the futures market are still open. Okay, but today itself will be a rather quiet day again. Why? Because the cash US stock market is only open half day. All right, so without further ado, let's take a look at what are the key economic data that actually allow us to pay much more of a close attention to. Will be the flash PMI data that was out yesterday during the European session, where let me share with my screen. Okay, so what we could see over here is that on yesterday, yep, over here, yep. So what we see a bunch of European and UK flash PMI data from the services and manufacturing for the month of November. So if you look at the Eurozone flash PMI data that was out yesterday, the manufacturing PMI data still came rather weak, 43.8% versus 43.8 level versus 43.1 previously, slightly above consensus of 43.4. The services one, inch slightly up, slightly better, 48.2 for November, below, slightly above 47.8 in the month of October, and slightly almost on par with consensus of 48.1. So all in all, what we could see over here is it actually represented a rather recessionary like scenario in Eurozone. And one thing in a more we call it a positive note will be on the UK side of the story, where the services PMI data managed to inch back up to we call it an expansionary mode, slightly above 50, 50.5 for the month of November flash, slightly above 49.5 in November, and slightly above consensus. But however, the manufacturing sector in UK continue to be in a contractionary mode, 46.7 in the month of November. Slightly better, but still below 50 as compared to the previous month of October at 44.8, and it came slightly above consensus of 45. And thereafter, this morning, Asia session, we have the inflation data out from Japan. So I could see the inflation out from Japan. The headline inflation actually rose to a 4-month high, 3.3% year-on-year versus 3% in the month of September. And if you could look at the inflation rate ex food and ex energy, the core rate over here, for those who wants to know what is the core rate in Japan, core rate in Japan is only excluding food. So Japan is pretty much unique. They have a core rate which exclude food and energy. So these tend to be much more volatile. So yes, prices still hold each down slightly below 4.2% in the previous month. It actually came down slightly at 4%. Year-on-year for the month of October versus 4.2% in the month of September. But all in all, what we could see over here is that inflationary pressure still remains rather elevated in Japan. So if you look at the core rate inflation first, you look at the trend. Okay, so recently it managed to tick back up in the month of October, okay, from 2.8%. And if so, all in all, right, what we could see over here is that it continued to remain close to, I would say, yeah, so it's close to about, I think, 19 consecutive month above BOJ target of 2% consecutive month. So all in all, that actually kind of also put further pressure on the Bank of Japan to actually start normalizing its ultra dovish policy. That means moving away from its short-term negative interest rate. Okay, that is the sole only developed central bank in the whole world that still has negative rates. All right, so later I will share with you, very interestingly, the dollar yen continues to actually struggle at the 50-day moving average, I think, as a resistance. All right, so now straight away, now given the fact that this is the key, okay, then one more key data to look out for will be in, it's a rather mixed reading for the services PMI and manufacturing services PMI data. For flash data, these are two flash data out in the month of November. For the services side, Japan services activity starts to improve slightly last month, 51.7, slightly above 51.6. So anything that's still above 50 is considered as expansionary in the services sector. Okay, so you look at it over here. Okay, it's still expansionary, but it kind of remain below a 12-month average of 53.5. Okay, then if we look at the manufacturing PMI, continue to be in doldrums, contractionary mode below 50, 48.1, much worse than the previous month of 48.7, and also came in below expectation of 48.8. So if you look at the trend over here, all in all, it actually represents a rather lackluster external demand environment. Okay, so now straight away, let's just jump into the technical picture of the FX market. All right. Okay, now let me hide my screen first, or let me expand my screen. Okay, so that you guys can focus more clearer. Okay, so now let's look at the chart. Okay, so what we see over here is this is the 5-day rolling performance of the FX major pair. So what we could see over here, right, all in all, in the last 5 days, the dollar starts to actually trade sideways. Okay, almost all the pair. So the dollar yen actually right now is trading at negative 0.08%. Given the dollar as the one of the top performer, 1, 2, 3, 4, 4 performers so far. Okay, but technically speaking, right, even though it's the dollars try to inch upwards in the last 5 days or so, but however, interestingly, if you look at the technical picture of the dollar yen over here, it's now the counter trend rally that we actually have in place that actually has really took shape within our expectation, that those who actually followed our daily dose of market insight since Monday. Now, right now it starts to struggle at the 50-day moving average. So bear in mind, in TradingView, we are able to overlay a higher time frame technical element on a shorter time frame chart, which is the hourly chart. Why hourly chart? Because we're not looking at a very short term intraday outlook on the dollar yen. But as we know, technical analysis, we need to have a confluence of higher time frame element to give us a bit of a more robust analysis while we do our we call it technical driven trading. We call it trading out technical analysis outlook as per se. So that's the beauty of TradingView. So all in all, what I could see over here is that I want to highlight is that the RSI going to inch lower. Okay, ever since the bearish divergence that was flashed out on Thursday, which is yesterday, going to inch lower as represented by this downward sloping line after hitting the overbought level. So indicating to us that there's a bit of we call it exhaustion on the previous push, the momentum of that counter trend rally that was seen in the last from Monday to Wednesday. So still no change. I'll be using 150.20 as my key short-term pivotal resistance, which is confluence with the 20-day moving average, and as well close to the 61.8% retracement of the previous down move from 13th of November high to 21st of November low. So as long as this level is not surpassed, potentially the dollar yen could see we call it a kind of we call it a bearish reassertion to at least retest the near-term support level of 148.40 in the first step. A break below exposes the this Tuesday swing low area at 147.45. However, if we start to see the hourly close above 150.20, then this ongoing short-term downtrend that is in place since 13th of November will be in jeopardy to see a squeeze up to retest 151.40 151.95, which is the major resistance on the dollar yen. Okay, so still maintaining that short-term bearish outlook as long as 15020 key short-term pivotal resistance is not surpassed on the dollar yen. Okay, now moving on, next will be the Aussie dollar. So if you look at the Aussie dollar as depicted on the daily chart itself first, price action now try to actually inch higher at the 65.95 level. Okay, holding above the near-term support at the 65 figure level, as you could see rather clearly. This is a very clear previous congestion area, former swing high that is taken up, retest, and hasn't break below it since the last 5 days or so. So now these are definitely two key levels to watch. So if you look at the hourly chart right now on the Australia dollar, so since the start of this week, we have been having a pretty much a neutral zone as well. So given the fact that if we were to see the current down movement of the Aussie dollar, the RSI now is also intending to break down below the 50 level again, attempting to retest this oversold region. So with that, right, I'll be still having this neutrality bias on the Aussie dollar. Okay, from here, let me change this in blue. Okay, so 65.20, 65 figure will be the lower limit of that neutrality zone, and the upper limit will be at 65.95. Okay, for the Aussie dollar. So still keeping within this neutrality range between 65.95 and 65 figure, and we see how it plays out towards the end of today. And given the fact that today is also end of the week as well. Okay, then now moving on, next will be the European currency. So if you look at the European currency yesterday, due to the much more we call it a kind of a resurgence of services activity in the in the UK economy, as expressed earlier or shown earlier on the flash PMI data, the sterling dollar spike up within our expectation, almost hit the resistance level, the first resistance at 125.40 before start to shape a minor pullback. All right, so since this level is not surpassed, right, 125.40 yesterday, I do not want to tighten the key short-term pivotal support to so tight to yesterday's swing low area, which is the low of this hourly bullish candle. So still using 124.40 as a key short-term pivotal support level. We also confluence with the 200-day moving average, still maintaining that short-term bullish outlook on the sterling dollar. For sure, 125.40 first intermediate resistance to watch, followed by 126.80. However, if we start to see an hourly close below 124.40, then we may start to see the start of a minor corrective pullback to expose the next intermediate support level at 123.75, followed by 123 figure level, which confluence with the minor ascending channel support that is in place since 1st of November low, and as well as the upward sloping 20-day moving average that is confluencing at a similar support level at 123 figure. Okay, Eurozone, euro dollar, pardon me. So euro dollar yesterday managed to actually inch up higher as well, but failed to actually break above the near-term resistance that we highlight yesterday, which is 1.09 level. So this level is something like a potential upside trigger level. So still no change. It got to actually break up above this 1.092 level to potentially give more credence for a further test on the next intermediate resistance at 1.099. So no change, still using 1.0830 as the key short-term pivotal support level, which confluence very closely to the 200-day moving average, and as well as the ascending channel support from the low of 2nd of November. So as long as 10830 key short-term pivotal support holds, we still look to maintain that short-term bullish outlook on the euro dollar. However, a breakdown with an hourly close below 1.0830, then we will start to see the start of a potential minor corrective decline heading down towards the next intermediate support zone at 1.075/1.072, which is so confluence with this upward sloping 20-day moving average. Okay, now going down forward, next will be the indices. Okay, so let us start with the Nikkei 225 first. So the Nikkei 225 over here, within our expectation, the price going to inch up higher at 33,825 this morning session hit. Then before I start to chip in minor pullback. So still no change. for sure 33,100 will be the key short-term pivotal support level to maintain this short-term bullish outlook on the Nikkei 225, which is the Japan 225. A break above 33,825 potentially sees us up towards the top of this minor ascending channel that is in place since 8th of November, acting as a next intermediate resistance at 33,410, which is also confluence with the one-time Fibo extension as well. But however, if we start to see a breakdown below 33,100, then we will start to see the start of a minor corrective pullback to retest the 20-day and the 50-day moving average, confluencing at a graphical support zone as well at 32,490 and 32,260. Okay, so moving on, next will be the Hong Kong 33 index. So for the Hong Kong 33 index, there's some fear going on in the China economy. Why? Because there's this particular news flow over here saying that unfortunately, there's this significant increased amount of we call it respiratory illness that is being spread around small kids in China. So there's what I call a potential some rumors going on that it could be a revival of COVID-19 in China again. That is still being unknown, but because the fact that it's has some fear in the marketplace right now, given the past of what happened 2.5 years ago, so that causes what I call a lackluster, we call it a movement that is seen today, currently intraday on the China stock market, and its related proxy, which is the Hang Seng indices as well. But one thing positive over in China over here is that there seems to be a increasing, we call it top-down directive from China top policymakers to ask state banks to be more lenient or to be more gracious in giving out loans to cash-strapped property developers. All right, so right now it's not confirmed yet, but there could be a potential policy change where top policymakers may allow banks to offer unsecured, okay, the key thing is unsecured short-term loans to qualified developers for the first time. Okay, so if this does happen, potentially it could be like a stealth QE indirectly. Okay, so for sure, if you look at the current situation right now, the Hong Kong 33 index is actually kind of lackluster right now, but it still managed to actually hold on to that short-term pivotal support that we have yesterday. So this current sell down is more likely driven to the fear of that rumored so-called resurgence of COVID-19 in China, due to the earlier that negative news flow I shared with you all, which is we start to see an unexplained significant amount of small kids in China having this respiratory, we call it respiratory illness. So, but still holding above the 20-day moving average. So for sure, 17,600 is the key short-term pivotal support to watch. First intermediate resistance to look out for the Hong Kong 33 is for sure this Tuesday minor swing high at 18,080 level. All right, so as long as 17,600 short-term pivotal support holds, potentially we may start to see a rebound back to retest 18,080 level. However, if we start to see a breakdown below 17,600, then this slide could potentially extend to retest this key medium-term support of 17,300, which is actually right now the ascending trend line support that is in place since 24th of October low that managed to hold previous sell off on 1st of November and 13th of November. Okay, so that's for the Hong Kong 33. So now German 30 index over here is going to slowly inch upwards, okay, above the upper half of this minor ascending channel that is in place since 28th of October low. So still no change. I'll be using right now, given the fact that price is going to inch high. So for today's level, I'll be much more prudent and tighten it, the short-term pivotal support level to this congestion area over here, which is at 15,930. Okay, so 15,930 will be my key short-term pivotal support for today, a tightened one, to maintain this short-term bullish outlook, heading potentially towards the next intermediate resistance at 16,050. Above it sees the next resistance coming in at 16,240 potentially, which is the upper limit of this minor ascending channel, and graphically is this is this congestion area over here. Okay, so however, if we start to say hourly close and break down below 15,930, which is so confluence with the median line of this minor ascending channel, potentially it could kickstart a minor corrective pullback to float down towards the lower limit of this ascending channel, or the lower half of this ascending channel. Support will be at 15,660, which is also confluence with the 200-day moving average as well. Okay, Wall Street 30, which is the Dow Jones Industrial Average. Okay, so yesterday price action was kind of sideways because of the closure of the cash market. So still no change. I'll be using. Okay, so given the fact that price action is going to is still kind of sideways, so I'll be still using 34,790 as a key short-term pivotal support level. Intermediate support for sure will be at 35,055. Clear breakout above 35,295 potentially could see the next resistance coming in at 35,830. However, if we start to see a breakdown below 34,790, then potentially we may kickstart a corrective pullback to retest the 20-day moving average, acting as a support zone, confluencing with a graphical support zone at 34,385 / 34,190, which is the pullback support level of this former medium-term descending channel resistance. Okay, that has been taken out last Tuesday. Now, what's next for the Nasdaq 100? So Nasdaq 100 still holding that intermediate support at 15,915, sideways above this level. So given the fact that yesterday was the closure of the cash market, I don't know put it so tight for the short-term pivotal support level. So still using 15,690 as a key short-term pivotal support level, still maintaining that bullish outlook. A clearance above 16,160 sees the next resistance coming in at 16,310. So with that, still maintaining that short-term bullish outlook on the Nasdaq 100. But however, a breakdown below 15,690 kickstarts a minor corrective pullback towards the 20-day moving average, and which is so confluencing with this graphical support level over here at 15,380. Okay, so now what's next for the commodities market? So for WTI crude, right, a bit of wild swing that we see recently, given the OPEC Plus earlier scheduled meeting this Sunday was actually this Sunday, 26th of November, is being postponed to next Tuesday, 30th of November, due to dispute among its members, among its members on what to decide on the future supply cut in the oil market. So with that, right, no change, still remain a neutrality stand between a wide range of 78.10. So these are two very crucial technical level. 78.10 since last Monday, after a swift up move on it, and it failed to break above this level. We saw confluence with the 20-day moving average, and going forward, the 200-day moving average, and going forward, the 20-day moving average will also be acting as a resistance around at this 78.10 level as well. So 78.10, then 72.70, 72.40 is the key medium-term support level, as seen on the daily chart over here, which is the the medium-term ascending trend line support that is in place since 20th of March this year, and the congestion zone of 8th of to 20th of June, and as well as the 76.4 Fibo retracement from the previous minor uptrend phase from 4th May all the way up to 28th of September high as well. Okay, so neutral between these two level for today, between 70 / 72.40 and 78.10 level. Okay, now what's next for the gold price? So for gold price over here, what we could see over here is that for gold price continue to oscillate within a short-term uptrend. That means holding above the 20-day moving average in place since 30th of November low. So with that, we still maintain that short-term pivotal support level at 1972. As long as this level holds, still should be maintain that short-term bullish outlook on gold XAU/USD. A breakout above 2006 add more credence to this ongoing short-term uptrend phase for the next intermediate resistance to come in at 2028/2037. However, if we start to see a breakdown below 1972, then we will start to see the start of a minor corrective pullback towards 1957 and even 1932, which is the confluencing with the 20-day and the 50-day moving average. So with that, I've covered the key highlights that we have that I would like to share for today. So with that, do have a great weekend ahead, and we shall speak again on Monday. Thank you.